Hi, my name is Jim and I was retired. We're in an AI bubble. AI's in all of the headlines. It's everywhere. So this week's video, I decided to explore Boldin AI versus Grok. Which one is better for DIY retirement? Stay tuned. First, AI is not a magic bullet. I know there's a lot of fear about there in many professions that AI will replace people. I'm going to take this from the DIY retiree's perspective. Number one, I'm not worried about losing my job to AI. When I began my retirement sooner than I expected a decade ago, I sought out efficiencies that would help me create a retirement plan without a 1% AUM financial planner. I knew I couldn't afford that. Now, I've done several videos on new retirement, which has since become Boldin. And I began using it when it was just almost a Kickstarter project. It was still a work in progress. And I've stayed with it and continued paying for the pro planner level because I view it as a necessary tool for DIY retirees. It's the thing that can help you mass customize your financial plan. Not all of us can afford fee-based financial planning. We need a tool like this, a TurboTax for financial planning. And I think Boldin still does that. Now, on the home page of Boldin, you'll see this AI Planner Assistance. It's a beta feature, and if you have not signed up for beta features, you may not see this yet. Go and subscribe to beta. And it's probably coming to all of us that use the Boldin Planner. Now, right there on the right, you see some simple questions you could ask the Boldin AI assistant, but they're very simple. And if you hit that button up there, if you want to expand this to a larger engine. By the way, notice this panel down here with the disclosures. It notes that the AI Planner Assistant provides general information and suggestions based on the data in your plan. It's not a substitute for professional financial, tax, or legal advice. And by using the AI Planner Assistance, you acknowledge these limitations and agree to the terms of service. So in the black box, I put this query, which is a lot more detailed than the simple ones on the prior page. Perform a break-even analysis on the current 2026 scenario to stay below 150,000 to preserve the New Jersey 25% retirement income exclusion and maximum $12,000 senior bonus deduction compared to making one more Roth conversion to max out the IRMAA level this year. What does that do to lifetime taxes paid, and what does it do to the spouse's widow tax burden? All of this relates to the way New Jersey taxes retirement income based on three tiers. If you keep your gross income below $100,000, as we did for earlier part of our retirement, then all of your retirement income is excluded from state income taxes. But if your gross income is between 100,000 and 125,000, you have a 50% exclusion. And if you go over 125,000, you only get a 25% exclusion. And if you exceed 150,000, you don't get any of your retirement income excluded from your income tax at the state level.
This is a sophisticated tax strategy question. To stay below the $150,000 New Jersey income limit for the 25% retirement exclusion and the senior bonus deduction, you have very little room left in 2026.
Now, I went on to note that the Roth conversion that I made in January, and make sure you see that video on how I started the year with converting the remaining 401k into a Roth 401k. That plus the pension, the Social Security income that Marie is taking on her own benefit, and the IRA withdrawals that I'm taking this year for expenses, there's very little wiggle room. But it noted that you could convert potentially another 68,000 before you hit the 218,000 threshold for IRMAA. You go over that level, you start paying more for your IRMAA in 2028 based on your 2026 income. So doing so, we would lose most of the $12,000 in senior bonus deductions at the federal level, and we would lose that 25% retirement income exclusion here at the New Jersey state income tax level. Boldin concluded with this.
In your current plan, your spouse's marginal federal tax rate is projected to jump to 32% in 2059 once she is filing as a single taxpayer. By converting more now at the 22% federal bracket, married filing jointly, you would be intentionally paying taxes at a lower rate today to reduce the RMDs she will face later as a single filer.
So I asked Boldin to go ahead and model another $68,000 in Roth conversions. But I noted that I'm leaning towards taking that Roth conversion for Marie as opposed to Boldin's preference for tackling my larger IRA first. Now, in the break-even analysis, it noted that we would pay roughly $20,000 more in combined federal and state taxes in 2026, but it would lead to lifetime tax savings of more than $150,000. And it noted,
this is the most dramatic impact. In your baseline, your spouse's marginal rate was projected to hit 32% as a single filer. In this hypothetical scenario, her future marginal rate stays at 12% for almost her entire widowhood. You are effectively prepaying her future 32% tax liability at a 22% discount today. By tackling her IRA first, you are aggressively shrinking the specific bucket that would otherwise cause her the most tax pain later in life.
now I concluded by asking what AI agent Boldin is using and whether the Roth conversion would be in our best interest.
I use a combination of Boldin's proprietary financial planning engine, FPE, and advanced large language models to analyze your data. The math behind your taxes, RMDs, and estate value comes directly from Boldin's deterministic planning engine, the same one that powers the charts and explorers you see in the planner, while I help interpret those results into a strategic conversation.
Now, Boldin cited three keys for the case for yes: the widow's tax hedge, helping to prevent her being taxed at 32% later, the lifetime tax savings, and here it updated the number to 426,000 in tax savings, and a higher estate value of 731,000. And I did note that those yeses, arguments for yes, were a little higher than the initial number they gave me before I asked Boldin to model a specific IRA Roth conversion. And Boldin listed two keys for the case for no. Completing the Roth conversion will result in an extra $4,000 in state taxes in 2026 we could have avoided. And the cash flow, you need to make sure you have the cash flow to pay that extra $20,549 in federal and state taxes for 2026. And then it concluded.
The verdict. From a purely mathematical standpoint of wealth maximization and tax minimization, the conversion is a clear winner. However, best interest also includes your comfort with a higher tax bill today.
So then I decided to take Boldin's AI's summary and I converted it into Word document and I gave it to Grok and I asked Grok to review it. Now, I've done several videos on Grok, that's XAI's little engine, and I'll leave a link up here to one of the later ones. So I gave Grok the Word document of the Boldin analysis and asked for its review. Now, since Grok doesn't have all the information Boldin has in my Planner Plus, I provided some highlights. Here's what Grok said.
The Boldin AI analysis appears to be a solid, data-driven take on Roth conversion strategy, drawing from a proprietary financial planning engine, FPE, that simulates taxes, RMDs, estate growth, and projections over your lifetimes. It emphasizes a classic tax arbitrage play, converting pre-tax IRA funds to Roth now while you're in the lower federal bracket. 22% for MFJ, and have more control over income to avoid higher future taxes on RMDs, especially the widow's penalty when your spouse files single after your passing.
Now, in Grok's analysis of the key strength of Boldin's reasoning, it included one little flaw in Grok's reasoning. This is a new field of AI, right? So look under the New Jersey Cliff trade-off bullet there. It mistook the senior bonus deduction for something related to New Jersey property taxes.
New Jersey Cliff trade-off. Boldin quantifies the immediate loss well. The $12,000 senior bonus deduction, likely referring to New Jersey's senior citizens property tax deduction or similar retiree relief, and 25% retirement income exclusion vanish above $150,000 AGI for married filing jointly in New Jersey.
Grok did highlight some potential weaknesses in Boldin's analysis. The assumptions in the Boldin planner for inflation and portfolio returns could swing the results. And it also noted the cash flow and opportunity costs of spending more on federal and state taxes in 2026. And it rightly points out that the ongoing conversions could compound state losses in future years. And this is one of the reasons why, although you can use a Boldin Roth conversion planner to explore a series of Roth conversions, they're all going to end up being decisions you make each year. But then Grok cited two potentials that I don't think are really issues. One is the IRMAA timing. Income in 2026 will lead to higher IRMAA charges in 2028, and it said that Boldin didn't calculate those but potential future charges. Well, again, I'm trying to stay below the IRMAA level, so I'm not really concerned about this. And then it went ahead and repeated that senior bonus deduction confusion. And it also pointed out that even though the math says that this is a clear winner, if my wife doesn't outlive me, then the widow benefit evaporates. And it noted that there's some engine transparency. Boldin is using an AI large language model for interpretation, but the financial planning engine does the math. And Grok asked if it's planning to model any black swans in there of major tax reform. Then Grok said it would need a little bit more detail from my financial plan to complete its own analysis, and I rounded numbers and gave those facts to Grok. Grok's final perspective: is this in our best interest?
Yes, I'd recommend the $68,000 Roth conversion from your wife's IRA. It's likely a strong move for wealth maximization and protecting her financially.
Now, it added a line there below about keeping her post-widow income in lower brackets and possibly avoiding Social Security taxation spikes. And I don't understand that at all, since I'm projecting that we will be stuck in 85% of our Social Security benefits being taxed throughout our full retirement. But anyway, I replied with that other information that Grok needed, and I asked for its own break-even analysis. So in addition to giving Grok the financial information it needed, I also clarified that the senior bonus deduction was something under the one big beautiful bill and applied to the $12,000 that we would get at the federal level. And I also clarified that our plan was to avoid IRMAA completely and manage income to stay below that level. So I'm not concerned about that. And in the end, I asked it to give me a final decision about the Roth conversion and focusing on her IRA first.
Yes, completing the $68,000 Roth conversion from your wife's IRA is in your best interest. The math favors it for tax minimization and estate maximization, especially the widow hedge. Your wife's smaller IRA grows the problem fastest post your death, and converting now at 22% federal plus about 5% New Jersey effective rate beats her projected 32% plus single rate on future RMDs.
Finally, I asked whether Grok was providing fiduciary advice in our best interest, and I got an emphatic no.
No. Grok is not providing fiduciary advice, and nothing I say should be treated as such. Fiduciary advice, in the context of financial planning, especially retirement accounts like IRAs or 401ks, is a specific legal standard under U.S. law, primarily from the Employee Retirement Income Security Act, ERISA, and the Investment Advisors Act of 1940, overseen by the SEC and Department of Labor.
So it went on to say that this analysis and perspective is not financial advice. It's like reading a detailed forum post or a financial article or running numbers in your own spreadsheet. Think of it as useful thinking, but you should always verify it with a licensed financial advisor, a CPA or a estate planner who can formally take responsibility.
Bottom line. Treat my input as a smart, up-to-date conversation partner or second opinion, not as fiduciary-level advice. For decisions involving hundreds of thousands in potential taxes/savings, always loop in a human professional who is legally bound to put your interests first, and who can be held accountable if things go wrong. If regulations evolve to cover AI like this, I'll update accordingly. But right now, they don't.
So I should take these as entertaining ideas from a DIY retiree talking to Grok? Is that what you're saying?
Yes, exactly. That's the perfect way to frame it. This whole conversation is essentially one DIY retiree, and I was retired, bouncing ideas off Grok, running hypotheticals, stress testing assumptions, and comparing notes against Boldin's outputs. It's collaborative brainstorming between you and an AI that's designed to be helpful, maximally truth-seeking, and willing to crunch numbers or challenge thinking without pulling punches. Everything we've discussed: Roth conversion math, New Jersey cliff impacts, widow's penalty hedging, IRMAA fill-up strategy, lifetime tax deltas, growth rate sensitivity, is useful food for thought. But it remains exactly that. Food for thought, not a prescription or personalized plan with legal weight behind it.
Now, I should stress that I am not paid by Grok or Boldin. I am completely independent. I'm not a Boldin planner or a Boldin partner. I am just a Boldin user. Nor am I paid by Grok. I am just an avid user of Grok and X in my communications to you. You can follow me on X at I was retired, the same handle that I use here on YouTube. How about you? Have you used AI in your financial plans? Let me know in a comment below. Have you tried Boldin's AI assistant, Grok, or any other AI tool in your planning? Hey, be sure to like, share, subscribe to this channel if you found it helpful to get some advice from a DIY retiree, not a planner. And I will conclude with my standard warning. I am not a professional planner. I have no initials after my name. So take these as entertaining ideas from one DIY retiree to another. Always do your own due diligence and seek out a professional if you need one.